Good afternoon. I'm Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. I'm being joined today for this special WTR Small-Cap Spotlight podcast by my colleague Jeff Robertson, Managing Director, Natural Resources Equity Research, to discuss his high-level views of natural resource trends in the new year. Jeff, thanks for joining me today.
Tim, thanks for having me. Good to be here.
So, Jeff, before we look ahead to 2025, how did energy equities perform during 2024, and what were some of the primary stock price drivers?
The XLE, which is a spider fund for energy, was essentially flat for the year. So it underperformed the S&P by a little over 20%. The OSX, which is the Oilfield Services Index, was down about 10% for the year. So it underperformed the S&P by a little bit more. There was a brief period of outperformance in April, which essentially coincided with the highest month of the year for crude oil prices. I think oil prices were about $84 WTI in April of 2024. So the decline in the second half of the year really dovetailed two things. One, it dovetailed a decline in oil prices. Natural gas prices had been weak really for much of the year, which led to a decrease in drilling activity early in the year. And it also really coincided with reductions in demand estimates for 2025. In OPEC's most recent outlook, in December of 2024, they estimated 2025 demand at about 105.3 million barrels per day, which is an increase year on year of about 1.4 million barrels per day. But that's down from a January 2024 estimate for 2025 demand of about 1.85 million barrels per day. So they pretty consistently revised down demand estimates for 2025, I think, based on economic outlook and also a fairly loose supply-demand fundamentals in the market. And I think that weighed on equities in the back half of the year. I think one of the things that did come about in 2024, which was important and may have implications going forward, is the E&P industry and really the service industry as well had some pretty significant efficiency gains in the year, and companies were able to drill more wells and more feet by employing fewer rigs. So I think laterals and horizontal plays and the shale plays are getting longer. That results in increased complexity of stimulation, increased service complexity. So some of that means that the industry can still maybe do okay with a lower drilling activity count. That doesn't necessarily mean fewer feet are getting drilled.
Great. So now looking to the new year that we kicked off 6 days ago, Jeff, how do you think the outlook is shaping up for energy equities?
Right now, I think we're still looking at a fairly flat oil price environment. I think the most recent forecast from the EIA for 2025 oil is about $74 a barrel. So it's about maybe a little bit higher than where it is right now. So essentially flat. Obviously, oil prices over the year will be driven in large part by the supply-demand outlook, but also geopolitical tensions with the new administration coming in and perhaps trying to put increased sanctions on Iran. If that has any impact on their ability to sell oil into the market, that could put some upward pressure on oil prices. Natural gas prices, there's probably a little bit of optimism. Obviously, this week it's quite cold, so cold is usually good for gas prices. And I think longer term, the expectation that U.S. LNG export capacity and exports and capacity will grow could spur some natural gas drilling toward the end of this year into 2026 as some of that capacity expansion starts to get a little bit more tangible in terms of when it will come online. So I think that shapes up for a year that's hopefully a little bit better than last year. There's been probably in the fourth quarter a little bit more focused on the gas-weighted names. There aren't that many of them anymore. So I think the performance for the oil shares or oil-weighted shares is probably going to be dictated by the commodity price outlook like it usually is.
Okay. Companies will presumably disclose their 2025 capital plans when they report 4Q24 results over the next several weeks. With that in mind, do you think they will continue to favor capital allocations that return substantial cash to shareholders?
I think it's pretty clear that the big cap companies and even the small and very small cap companies are really favoring trying to return cash to shareholders. I think that the growth that the industry achieved in the early days of the shale revolution led to over-leveraged balance sheets and a lot of financial turmoil. I don't think anybody in the industry wants to repeat that. And obviously, the shale industry is maturing. I think the Permian Basin production in November of 2024, averaged about 6.5 million barrels a day. That's up from about 6.2 million barrels a day in November of 2023. But the EIA's outlook for December of 25 only has it at 6.63. So that suggests that the shale industry in the US is starting to mature. And I think in light of that, companies are going to continue to reserve cash to return to shareholders and try to deliver returns by being more efficient and also delivering a yield to their shareholders.
Kind of a follow on to that, Jeff. How do you think oil and natural gas price volatility might impact their initial plans?
I think given what happened in the fourth quarter, there might be some caution around budgeting. I don't expect to see a lot of real material increases in capital spending. I think the budgeting cycle in 2024 was probably a 75 plus or minus dollar oil world. I think the budgeting cycle for 2025 is similar, maybe slightly lower. So I don't think there's going to be a big change in companies' capital priorities. There's been a tremendous amount of consolidation that's taken place. I think there's a lot of companies that are putting two asset bases together and trying to figure out how to prioritize spending across the two assets.
Speaking of consolidation, there was a fair bit of corporate consolidation in your sector in 2024. There's certainly broad-based talk about many industries seeing accelerated M&A with the new Trump administration coming in a week or two. Do you expect that trend to continue in your sector in 25?
I think consolidation will continue. I think that's essentially a constant in the oil and gas industry. I think what we may see in 2025, though, is a shift more toward portfolio rationalization. In both 2023 and 2024, there was a lot of corporate consolidation with the goal of taking out duplicate costs, creating a more efficient asset base, capturing inventory in plays, trying to become a more efficient big company with the goal of being able to generate more free cash flow to, like we talked about earlier, be able to send more of that to shareholders. So I think as companies digest the acquisitions that they made over the last couple of years, I think by my count, and this is certainly not complete, there's been about 260 billion worth of M&A in the last 2 years. Roughly 170 of that was in 2023 and about 90 in 2024. And so I think we'll see portfolio rationalization that most likely will create opportunities for smaller companies to look at asset packages to help them scale up, because I think there is a valuation difference between companies that have more scale and more cash flow and generate more free cash flow than the smaller companies.
Okay. The incoming Trump administration has stressed a desire to increase domestic energy production. What steps do you anticipate it might take to advance those goals?
I think probably the thing they can do with the most near-term impact is maybe streamline some of the regulation around permitting on federal lands, permitting for pipelines, have a more routine or more regular offshore lease sale in the Gulf of Mexico. Pardon me. The Biden administration just today, I think, announced that they were going to restrict access to federal leases off the east and west coast and in some parts of Alaska. And that's really the industry hasn't leased in those areas in decades, so that doesn't really affect anyone's near-term plans, I don't think. But I think you'll see an administration that's more receptive to the industry having access to drill where they on some federal lands where they already can. But I think the industry is only going to drill wells if they believe it makes economic sense. They're not going to go out and drill wells if the price doesn't support the kind of returns that they want to generate.
I'm glad you spoke to the Biden administration inking that regulation today because I did have that question in the back of my mind. I saw it scrolling across Bloomberg early today. So lastly, Jeff, the industry has been actively participating in a variety of energy evolution projects to decarbonize and develop renewable fuels and energy capacity. Do you anticipate the theme continuing in the coming years? And what might that look like?
I think it will continue. I think there's maybe some talk around whether or not some of the provisions in the Inflation Reduction Act, um, whether or not any of the tax credits and tax benefits for pursuing some of these type projects could be changed. I think the industry, at least most of the big companies, many of which are pursuing these types of projects, are supporting them and supporting the tax credits. So I think their goal, I believe, is to decarbonize their own businesses to make them more competitive on a global scale. If you're going to do business in other parts of the world, I think that's going to continue to be an important factor of how host governments evaluate companies and what they're able to do. So I think that train is out of the barn, and I'm not sure it's going to be put back in. I think what we'll see is probably a continued effort to monitor methane emissions and try to reduce those as much as possible. I think CCUS, or carbon capture and underground storage, will still be a big part of the investment cycle. Oxy has a big project out in West Texas. Exxon has been a big proponent of that along the Gulf Coast, as have others. And that was really the rationale behind Exxon's acquisition of a company called Denbury, which owns and operates CO2 pipelines along the Gulf Coast. So I think those initiatives that are in place by those companies, I don't think they're going to change anytime soon.
Thank you for letting us glean insights into how you're thinking about select natural resource trends in 2025, Jeff. To read Jeff Robertson's industry and company-specific equity research reports, as well as to access countless other small-cap equity research reports from Water Tower Research, please go to www.watertowerresearch.com.